Prateek Agarwal, Chief Investment Officer with ASK Investment Manager joins us, or Ask Investment Manager joins us. Prateek, good morning. Thank you for joining us. It's turning out to be a good week of trade for Indian markets. Gradually, but surely, Indian markets have managed to climb the wall of worry.
Yeah, valuation got a bit depressed during the result season, and after the result season has been through, Parliament closed down. In terms of bad news, not much can happen between now elections and the next quarter numbers. So it is more, to my sense, a relief rally, kind of a rally in the part of the market where numbers were not good. The other part where numbers have been good consistently has been moving up consistently over a period of time. So, I would tend to see the markets in this manner.
Prateek, of late we've been seeing some traction build in for the cap goods space, and it seems like, the election hope trade is still playing on. How long do you think the move in capital goods is sustainable?
So capital goods, while we tend to look at it as one segment, there are several sub-segments. So, for example, people focused on the transmission distribution part of the market never got impacted very negatively. The order books there continued to happen all through. The industrial part, of course, slowed down. The thing to see in the capital goods space is that there is a part which gets benefited from more stringent guidelines of emission, etc. So the guys who make motors, generators, etc. Benefit. So that part of capital goods we like. But otherwise, most of the other names catering to domestic capex story, revival of big industrial spending, that we see is quite far off. Second, if you look at the valuations of most of the good capital good players, the valuations are close to peak valuations. So all that you are trying to get by investing into those names is one, an EPS upside, and two, to some extent, operating leverage. So, many of these companies may be operating at subpar levels, and as capacity utilization improves, they may make more money than what an order book increase may suggest. However, these are still extremely early days for that to happen. We haven't seen order books increasing in any significant manner for any of these companies. I think the stock market, to my mind, is running slightly ahead of reality.
Prateek, whereas this announcement of index change, some would argue, is on expected lines, the change is that IT will now have a disproportionate amount of weightage on the Nifty. So earlier, just like we used banks for benchmarking purposes, now I guess it's IT which will decide how Nifty will move.
Well, banks are still a very large part of the index and are a disproportionately large part of the index. IT, even after Tech Mahindra, would be like 15% odd. So I would tend to believe it would be similar to oil and gas kind of weightage. The good thing is, in terms of financial numbers, IT is very good. The ROCs, ROEs of the sector is very good. The discounting of the name that is coming in is on the cheaper side. So overall, what happens is this name pulls down the index average numbers and improves the quality numbers. So overall, the mix improves. The other name, I am not so sure. In terms of valuations, it is just too expensive. So at this point in time, when one would want to let the index actually show the actual valuations on the ground, I think the move will actually increase valuations a bit rather than show it in actual light.
Prateek, Maruti has finally issued some clarifications on the Gujarat deal. They are clearly defining the transfer pricing norms now. As a minority shareholder, are you satisfied with the explanation which has come from Maruti Suzuki on how transfer pricing will work for the Gujarat plant?
Yeah, I would think the opposition that minority shareholders have had on the transaction is having effect. So the company is trying to address those issues, but this was something which was clearly avoidable in the first instance itself. They need not have taken such a step.
So what is the right way to look at Maruti? I'm not seeking for a buy or a sell recommendation here. I respect your compliance, but I'm just trying to understand the general approach. Do you think Maruti is a good bargain buy because valuations are attractive?
Let's not take names, but let's see, take an auto company. Here the issue is that there is cash which is being generated by a company, and how is it being invested? Okay, but let's keep the name aside. Let's just look at an auto company. What is an auto company? Auto company would have manufacturing, it would have a brand, and it would have capability to design a car. Okay, so these are the three things which make up an auto company. Now we have to decide which are the two things which are most valuable. So in the past, Maruti did not have R&D. It used to source R&D from Suzuki, used to have manufacturing, and used to have a brand. Now incidentally, both of these are higher ROCE parts of the equation, but give you the vulnerability of not having your own R&D, and the guy supplying R&D would always squeeze you down. Now going forward, what is happening is they are having R&D and they are having brand. They were outsourcing manufacturing. So per se, it would have been a positive to my mind, except that since the parent itself was putting up a plant and these guys had cash surplus, etc., so the whole issue got mixed up very, very badly.
I think for those who just bought IT, irrespective of large cap, mid cap, small cap, they've made money. But do you think now it's time to differentiate within the IT sector, within the IT space, within that group?
Before I say anything, we are only with large cap IT because there we believe predictability of what is happening is higher and volatility of earning stream is lower. But this is a space wherein every participant has been telling us that they are seeing better times versus what they saw last year. So companies should be able to deliver good numbers this year as well. Just one thing, last year's rupee depreciation bumped up earnings very, very significantly. This year, even if let's say the industry grows at 14-15% overall, because of cost pressures, etc., in the absence of a rupee depreciation, the overall EPS increase may be sub 15% for most of the companies except for one or two. So if this is something that excites investors, they should continue to hold. Otherwise, one should be clear about what one is betting at. Volume growth is 15%, cost pressures will take away 1% or 2%. So unless rupee depreciates, you are getting a number, the EPS growth number to be sub 15%.
In between our last interaction and this interaction, as a portfolio strategy, as a portfolio approach, has anything changed?
Yes, between last time and this time, I think we have reduced exposure to banking even more. We believe the stress time continues for the banks which are doing well. The valuations are probably at unsustainably high levels, and hence, our exposure to banking space has gone down even further.
If you're selling banks now, do you think you could also run the risk of selling the banks at the bottom of the cycle, because if economy recovers, banking sector will also recover? Is it too late to sell banks now?
No, so our thoughts are as follows. One, we did not have any PSU bank. We only had private sector bank, and if you look at the good private sector banks, the valuations are way higher than where they could be justified in an event Basel III happens over the next 3 years. So with those kind of banks, what you are buying is close to a 3 times price to book, when Under Basel III, what will get sustained is closer to 2 or between 2 and 2.5. So all that you are getting is maybe the earning increase kind of a momentum, while some of these banks will also come up for equity fundraisings. So to us, it seemed like a trade. It's no longer an investment. There are very few banks who offer both valuation upside and earnings upside, and they are focused on the corporate lending side, where the pressures on balance sheets are very high. So that is our reason of going away from banks. Now I buy your argument saying economy recovers, banks should recover, yes, but look at it this way: economy recovers in 2015, calendar 2015, FY 2016 in all probability. So when it happens, banks improve numbers, but Basel III starts to bite from FY 16, FY 17, FY 18. So in that 1 year, the amount of money banks would want to raise from the equity capital markets would be huge. So for banks to be, investors would have lots to choose from. That's my simple submission.